Yeah. Good morning. Yeah. I guess we got to get going soon, huh? All right, good morning. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money, cannot afford to lose. My name is Wayne. I'm a currency trader. I've been doing this for just about 20 years, maybe slightly longer than that as a full-time career. Before that, I was a venture capitalist. Before that, I was a high-tech entrepreneur. Before that, I worked in the nonprofit world. Before that, I worked at NASA. And before that, I had a paper route. Look at this monitor I can lift up and down. Whoa, that's probably better, huh? Anyways. So I used to have two paper routes, in fact, and worked hockey games as well. Why would I do all that? Because I love money. I loved money as a kid because I grew up with no money. So as soon as I realized if I work really, really hard, I can have as much money as I want, which is really cool. So that was nice. Yep. Work hard, stay focused. So with two paper routes and working hockey games selling Coke, get your ice cold Coke. I could have like an Italian bicycle. Yeah, so like 7th and 8th grade, I'd go to school and I had gold pens and pencils, gold-plated pens and pencils. Yeah, because I wanted to be rich, and I figured, hey, that's what rich people do. So anyways, I did my best. So you can imagine 3rd grade in like the poorest school in the whole city, and I have a Montblanc gold mechanical pencil. Why? I thought that was the path. That was the path. But the thing is, I got there not because my mommy and daddy gave me money, because they ain't got no money. So anyways, hard work. And fast forward a billion years. Look, here we are. And Forex never gets easy, by the way. But what an interesting gig that we have, huh? Yeah. But hey, thanks for bringing it up, Milos. Hey, thanks, man. I look like Gordon Gekko. Yeah, everybody likes to look like the 80s. How about that? Is that better? Definitely not Gordon Gekko now. All right. So anywho, guten Morgen. We will get on with it today. We have some housing data again this afternoon, and then we have weekly. Yeah, flock of seagulls now. Hey man, at least I got hair. Huh? A lot of guys my age, they don't even have hair, so cool. So yeah, it's a tough gig, but it's an interesting gig. So we got real estate news coming out. We have continued earnings coming out. All that kind of stuff. So it seems like the market is kind of waiting. So we will take a look at that and break it down. We will look at gold, oil, Bitcoin, and all that kind of stuff. We'll look at the the stock market. If you want to look at the ASX or DAX or FTSE, let me know. Generally, I go to the S&P 500. But what an amazing, wonderful trend we have in the DAX right now. Okay. And you're like, what's the DAX? That'd be a good question to ask, huh? Oh, we can go through that. In the description below the video, there are links to my book. There's a link to QuantBox. There's a link to FX Bootcamp. There's a link to tradersway.com. Now, we all need a broker for sure. You don't need education. You don't need quantitative analysis. You don't need no book, but you do need a broker. Tradersway.com is the broker I recommend to you. So if you're like, hey, who's this Wayne guy? What's he doing? And you're like, haha, he's kind of funny. Cool. Well, then go check out Traders Way. And you will find, if you download a demo account, play some practice trades, they are faster, they pay better, the spreads or fees are competitive. You'll like them, I'm telling you. You'll like them. That's why I recommend them. But they earn my loyalty and respect. So give them a shot. Maybe they'll do the same for you. Tradersway.com. Oh, look, I got it on the wrong page. Move that over there. La-di-da-di-da. Family does want to know about the DAX. Okay, well, let's start there. Let's start with the global stock markets. The DAX is the German stock market. Okay. And up until recently, had been trending wonderfully. Looks like it triple topped off the R. Okay. Off the R. Resistance. 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 Collapse. Now, bulls can start coming back to the market around this point, but you'd have to use a smaller time frame to confirm or deny that. Why is this area here resistance? Oh, good morning, Todd. Hey, Todd, are we doing a mentorship? If so, we gotta schedule that. Why is that resistance? Well, that's just simply a monthly pivot point. So before it doubled or triple topped, we already knew it was resistance, right? No, it's not M4. No, that's R. Resistance. R1 resistance. So it does matter. It does matter because the market's not supposed to be so worried about it there. But, you know, the market's got a lot on its mind lately. But look how wonderful the trend has been. And notice that no matter what, even if it regains its strength, there is a change that now, let's say, the 55's in control, no longer the 21. So it's definitely slowed down. Okay, so no matter what, it's slowed down. Oh, you mean weekly? Okay, family time. Okay, I see what you're saying. You have to indicate the time frame when you say it. So I'm showing monthly, and you're like M4. I'm like, that's not M4. Oh no, it's weekly. Well, you got to do WM4. Okay. Let's see what you guys are doing. Let's see what you're up to. So you might be watching gold and oil and S&P 500, but you're trading buck. That makes sense. So be careful in here in this zone. Well, bulls should definitely walk away unless you're watching a much smaller time frame and you're waiting for up. But it doesn't appear to be happening anytime soon. Okay, FTSE's still moving sideways. Okay, so now you got to trap it. And because everything else is trying to head back down, you should consider, probably the same. Take a look at S&P 500. Okay. No, there's a possible change in trend of family. Okay, family time. The trend is still up, but the price is down. Market's up, right? Price is down. Very, 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 very similar price action here. So it does show me that it's macro. Technically, you would have expected for bullishness to head quite a bit higher. 42.5 was our number a month ago. And we only got to 42. Okay. So there's still meat on the bone, but nonetheless, it is rolling over potential resistance. Not technical resistance, okay? So we'll see, it's price, not market. What this does is it opens the door to allow me to hedge the S&P 500 or buy some dips on certain things. Right? Now, the nice thing about a covered call strategy that I'm designing is that you're hedged. That's the whole thing. Wouldn't it be nice that you're always hedged? Well, some might argue, well, it's not good to always be hedged because then you limit your upside to protect yourself from the downside. Think of it this way. If you spend money on your insurance and your house doesn't burn down, then you wasted money, right? You burned the money. Well, but you're hedged because you have insurance just in case your house does burn down. So it depends on how you look at it. And so what you want to do is offset that by renting your house for a profit, which pays for your insurance. I don't know if any of that makes any sense, but so yeah, we got to be careful. It did make a higher high. We still have to pay attention to higher low, but nonetheless, this is real. Yeah. It does, Sky Killer. That's what I'm saying. I'm not disagreeing with that. That's what okay. So what I'm talking about, my thought is, let's say we go here to here. Maybe not this month. Maybe it takes 6 weeks to do it. How do I handle that? Now, you might just say, oh, well, you sell and you know, that kind of stuff. Well, we're talking about the stock market. So I'm also long-term long, right? I own the stock market. I have a retirement account. I have assets, bruh. Right? And we know through correlation that down could also mean like down for the value of your home. Down could be rates going higher and all this stuff. Okay, you see what I mean? Like, so, yes, I could just Okay, sell. But notice that even if this creates a lower low on a 4-hour, I still can't sell it till I have a lower high. So I'm still left with, I don't really want it to fall. I'm already long. And then how do I adjust? So what I owned in the past to hedge myself was SPXU. And so should I buy some SPXU again? I don't know. Then I look at my portfolio and there are some dogs in there. Should I cash out my dogs with the least loss possible? Because maybe if this, because remember, as an economist, I believe we have serious downside risk in the S&P 500. Serious. But if you attended my quarterly outlook and my annual outlook, you'll know it's not now. So do I give up on this, which was a predicted move? The up is a predicted move. That's not right. Should I give up on that, or should I just go neutral? Should I start hedging? Because maybe the downward move is not later this year. Maybe it's now. This is the top, and now we're going to go back to 3,000. Well, if I thought that, then I'd have to load the boat on SPX and, and all that kind of stuff. But okay, so, but are we there yet? And I'm like, well, I am worried about this. That is a top, there's no doubt. And on a 4-hour, okay, the second part of this that I need to pay attention to is, right, top, 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 lower low relative to that low. Okay? So if I were a bear, okay, I would sell the next up, not now, but the next up. Okay? And that could just be my form of, once again, hedging using this asset to hedge my cash position in my retirement accounts, right? And then I check the daily to see how bad the risk is. And I'm like, you know what? I want to buy it. I want to buy it back at 40.50. You know what I mean? I'm like, yeah, okay, so maybe it's down, but it's not down. So maybe the trade plan here is more like this. And I'm like, okay, yeah, so I'm not ready to abandon the strategy quite yet. And it's probably going to be based off of a price in here, actually. So maybe it'll be down the rest of the day and up all next week. What do you think about that? Okay. See, I don't want to throw the baby out with the bathwater. Should I abandon my retirement account and go to cash on everything? Well, I ain't ready for that. So right? So look, this is why we gather as a community. I don't have the answers. I'm contemplating what to do. I have to look at things technically and fundamentally. In the day trading group, the last 4 days, I've just been talking trader psychology, how to be truly patient and disciplined. Even though it seems like nothing's happening, I would argue, as someone with 20 years of experience, I look back and I'm like, those sessions, I think, are probably the most valuable. Even though some of the members are like, man, nothing's happened for 3 or 4 days. Hey, look, I'm not control of the market. But in sort of looking back and what I would have liked to have learned early on in my career is that patience and that discipline. And watch me to squirm for 4 days while I make decisions and I wait for setups, probably the best thing ever. Probably, you know, but as a coach, I feel bad because I'm like, man, they want me to do something. But I have to keep telling myself not trading is a position. No position is a position. Neutrality is a decision, right? And so anyways, these are big decisions, and we're in this point where I look back and I still look at this and, well, it's not bearish yet, is it? It is a double top, and I should be concerned. I wouldn't add new positions here. But I am considering buying dips and moving money around. So like I said, like what's one thing we could talk about? Well, we are definitely at a double top. And we don't know to the extent the double top holds. And by double top, I just mean this. It's not really a double top. But let's say we're at a top. Okay. So anything that I owned down here that underperformed, or owned here and is underperformed, and owned here and is underperformed, okay, I could get out of those underperformance. So let's say I owned a stock that was down 10% here, and I'm unhappy with it, and now it's only down 5%. What I could do is, as a risk management thing, is say, okay, I'll get out of with a -5, but now I got that cash to put into something better. Okay? Sky says, coaches, the Monday, Tuesday, Wednesday. Don't forget Sunday. Sunday, Monday, Tuesday, Wednesday. It's only the day trading group. Yeah, the day trading group is only for day trading group members. Yes. All right. Right. But remember, day trading members go to swing trading group meetings too. So day traders meet once on Sunday, once on Monday, twice on Tuesday, once on Wednesday, and one on Thursday. Okay? Swing trading groups meet Tuesdays and Thursdays. So it's, let me do it again. So for $99 a month, you meet with the coach twice a week in swing trading. Twice, right? So what is that? 8 times a month, 8 meetings a month. Okay, for $99. Okay, that's swing. Now there's Sunday, Monday, Tuesday, Wednesday, Thursday. So you meet day trading group meets 24 times a month for $199. There you go. Is it 28? Anyway, so Meta says it's 28. Or no. Yeah, 28 times a month. Okay. Yeah, I thought I did that, but anyways, whatever. Somewhere between 25 and 30. It's enough. It's enough is all I'm saying. It's enough. All right. So anyway, decision-making time. I have this risk, but I'm looking for this reward, and we're in a gap. You see? And there's plan B. No, there's no coupon. Hasn't been a coupon for years. Cool. So, right on. So, there's the scenarios that I'm dealing with. And notice I'm not preaching. I'm just sharing the thought process I go through and all the decisions I need to consider. When do I kind of do speculative short-term trading as a hedge? Where when do I do longer-term true hedging? Okay, like this big collapse here, I was hedged the whole time. And this whole move, I suppose, right? This whole move I was hedged as well. Triple leverage hedged, right? So anyways. So what to do? Yeah, but I am, my prime goal now is building my covered call strategy. And it's doing very well. Now, the stock market's going to come down, which means the net asset value will come down, but it won't adjust the income. The income is the consistent part, and that's why you're hedged all the time. All right, so anywho, lots and lots of vulnerability. Okay, lots and lots of vulnerability in all the macro. Okay, so that would lead to potential dollar strength today. And, well, dollar ain't weak. And now look at this over here, yo. Yen. Huh? Creeping. Creeping death. Yeah, it's creeping. Creeping to the up. Not quite yet. I wouldn't call that a breach of the trend, but this is why we're measuring it. Look at that. Maybe a change in trend. Maybe a change in trend. Dollar likely to be up today under all that risk off, unless things change. But why would things change? Weekly jobless claims? Not likely. The real estate coming out at 10? Not really. Okay. Pound stabilizing, Kiwi still weak. Okay. Euro being taken down with the risk off. You know, I was looking at things earlier today, like, you know, something was up, but then Bitcoin was down. And again, very much a mixed bag in these markets. And when I see mixed bag markets, it's just risk with almost no reward. Okay, so like, here's the S&P 500 down. And Bitcoin recovering. So which one's right? Well, they're both right. Well, which market do you want to participate in? I don't know. They're right because that's what's happening. But when the stock market's down, Bitcoin should be down. But the stock market is at support and Bitcoin's up. So does that mean Bitcoin is leading saying that the stock market's going to recover? Or is Bitcoin wrong or setting up for the next sell? So the S&P 500 drops at 9:30 and then Bitcoin does one of these things. Is right like that. So it's like, is the S&P 500 setting up a Bitcoin drop, or is Bitcoin indicating that the S&P 500 is going to rally? Well, the thing is, I don't know. So do I want to participate in a market in which we lack congruency between Bitcoin and the S&P 500? And I say no. That's not what I want. That's not what I'm looking for. Cool. Now gold. Okay, this is it. Notice how lovely gold has been behaving. And that's starting to feel real good. Huh? What do you stink? Starting to take some shape on the higher time frames. Now, you might have missed all this on the shorter time frames. Okay? Okay? You see it? It's nice, isn't it? It's nice, right? Remember, we already have this lined up. Should be another 100 pips or $100 to the upside on the short run. But I would argue, and I have argued, that this is a time-based trade, not a price time trade. What I mean by that is you hold this until July 1st. I don't know what the price will be on July 1st, but on July 1st, you take your profit. Or move your stop, one of the two, right? Lock in profit, we'll say, right? Okay. Now compare that to a chart like this. Okay, this is a harder one to trade. But do you remember doing this? I might have done it in the day trading group. So I remember doing this. Can't remember for whom did I do this. We had a plan A and a plan B. And the X represented the daily 21. Now, of course, this was several days ago. But the X, so we started on the daily 21, just like my book says. Okay, start on the daily to create strategy. And then we broke this down into a plan A and plan B, which would have looked like this. Plan A, and the other one is plan B. And that's it. Plan A might have been this one. It's hard. I'm not sure. Okay, I don't. It's the same idea. Okay. So Sky's like, well, it might be stopping at the weekly central pivot point. That might be true, but my macroeconomic analysis for this position is far beyond the week. I'm literally talking all the way to July. Okay? It's a time-based trade. You're saying like, yeah, on the second leg of what, 15 legs? So, at some point, I'm just looking beyond that. So you're talking like this is going to be an issue. Oh, yeah. But I'm seeing through it, so to speak. Right? So you get this, 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 you get this. So it's strategy at that point, right? Yeah, you're saying you'd like to buy the higher high, which is fine, but it's actually the higher low. Okay? So this is where I have to poke you in the eye. Yeah, right. I have to, right? Yeah. Oh, you wrote it wrong. Well, here's the thing. It's a subliminal, right? It's subliminal. You took the time to write it incorrectly, which means you were thinking it incorrectly. Now you intellectually say, no, that's not what I meant, but you subconsciously did. And when we're trading, it all begins intellectually, right? Like I've seen, I used to do I didn't do it very often. In FX Bootcamp, I've avoided doing a lot of things, and one of the things I've avoided is like the weekend seminar thing. But I have done a few just because I like to meet people. But it's one of these things where you can watch somebody all day listen to me train, and they're like, yep, makes sense, yep, makes sense, right? Intellectually, makes sense. And then you go to that person after they're saying, yep, makes sense for 6 hours. And then you're like, okay, now explain this chart to me, go through it and do a setup. And they're like, I can't do it. Right? Because all of a sudden, all the other stuff kicks in, the non-intellectual stuff, the emotion and all that kicks in, and it's the other part of the brain. But we all know that that's the part that needs to be retrained. Right? So anyway, so I think it's fascinating that you're like, oh, no, I wrote it wrong. Yeah, isn't it like that? Well, that's who I need to appeal to, right? Sky Killer. So that's cool. I'm glad you did it. Thank you. So thank you for being brave too. Thank you for being brave and sharing that with us. So anyways, yeah, so maybe in here or whatever, but depending on your time frame, you can now engage. Okay? So you can engage the enemy now. And you could wait for that, or you could wait for this, or you can wait for this. Okay, so you can do the pachow. Okay, or a little lower pachow, or yet again, even lower. Ooh, that should have been a third color. Come on. Okay. Okay, but the thing is, you are only looking to buy a dip. And that's that. And how many amateurs right now are selling this, huh? Ugh. And I fear when an amateur does that, they make money. Because I believe if you sold this now, because you're like, I'm going to sell the central pivot point, and even though it's moving up, even though we have persistent inflation, I'm going to sell it high off of the central. My fear is they make money on that trade because it'll somewhere between 7 and 15 times you'll have to lose doing the same thing for you to realize that the one time you made money was a fluke. So you'd have to lose 7, 8, 9, 10 times, 15 times until you tell yourself, I'll never do that again, because it always loses money. Huh? Takes a long time to get that hope out of our brain. So yes, it could do that. Okay. But I really want you to think about what you want to do. I don't know if this differentiates boot camp from all the other gurus, but I imagine it might. Where I'm trying to teach you how to be, not just a portfolio manager, not just a trader, not just a portfolio manager, not just an economist, like a strategist, okay? But the hedge fund manager in total, right? Like all these roles. And that gets you to a really interesting question, like, do you actually want to own gold? It's a pretty simple question, but if someone with money comes to you and says, I need your advice. I have a lot of money and I'm worried about something. Tell me about gold. Should I own gold? Could you have an intellectual conversation about should somebody with money own gold? And ideally not, a crazy conversation about gold. Lots of people can have crazy conversations about gold, but rational. Okay? I always kind of get antsy when somebody says, well, you should own gold and high-powered rifles and ammunition, and you should have a bunker in your backyard with a whole bunch of MREs. I'm like, dude, Far Cry 5, man. I got enough of that in Far Cry 5. Huh? Preppers are lonely. Right? Preppers are lonely. Man, I love video games. Video games are so fun. One of the coolest things ever, right? One of the coolest things ever is to play video games with your children, right? And I swear to you, the whole family's, I think it was in Tuscany. I rented a convertible, threw the whole family in, and we're driving through the tiny little hillside roads of Tuscany. And, the girls in the back, the boys in the front, and we're driving, everything's great. And we go through this little village, and up on a second story balcony, there was this dog. And I yell out, Boomer! My son looks at me like, oh my God, it's Boomer! And we both get excited because Boomer is a dog from Far Cry 5. And you end up loving these pets. So it's a dog in Far Cry 5, a video game. Oh, but the dog, he helps you find animals. He barks when there's bad guys. He jumps in the truck with you when you got a car, and he jumps in and he sits next to you in your truck, and you're driving around through Hope County with Boomer. And anyway, so we saw Boomer and we both got excited. And how cool is that, huh? Where you and your kid are sharing a moment because you just noticed your virtual dog. You can even pet him, yeah. Anyway, so yeah. How cool is that, eh? Boomer! All right. So anyways, look it's already happening. Okay. Yeah. Well, what I'm getting at Sky Killer is because look, newer traders lean on technical analysis, and I don't have a problem with that because we all need to master technical analysis for sure. Okay. But then traders seem to pause. They don't get beyond that. And my guess is when you decide to start a YouTube channel and have people follow you about how to trade, Google and YouTube doesn't say, hey kid, are you licensed and registered? Do you have any money management experience? Do you have an economics degree from Harvard? No, any idiot can become an expert trading Forex on YouTube. No qualifications, right? And so most people don't have qualifications beyond they know what a moving average is, they know what an oscillator is, right? And so people, I think, get stuck because they never answer the real question. Should you own gold or not? Well, that's a complicated question. You got to look at a lot of different things. Monetary policy, macroeconomics, inflationary pressures and your outlook for maybe change in those pressures. And that's a whole different thing. But if you start with technicals, it's great. But later on, if you focus more on what an institutional investor would do, they would start with the decision, should they own gold in the portfolio? So if later on you get better education and more experience, and you can start with the question first, not what to do. What to do is just tactical, but it doesn't lead anywhere long term, right? Now you might say, well, there's the trend traders like Michael Covell, is that his name? Am I remembering his name right? And there's like trend trading strategies. The best thing about those types of trend trading strategies is that you stay in the trade for a long time. That's why it's a trend trade. The worst part about those strategies is you stay in the trade a long time. Its strength is the weakness. You're in for a long time, but you're in too long, really. Okay, so that's his name, right? It's Covell, right? Michael Covell. Yeah, and so great. Like, I'm not saying anything negative about him, but he'll often talk about it's all rules based, and by rules based, I can't say what he does, and I haven't studied their technique. I imagine it's something, like what we would have here. Like if the moving averages cross down, then you're out, right? Okay. But we all know moving averages are lagging. So and Michael Covell would say something like, you don't need to understand fundamentals. Ignore all the fundamentals. Okay. That's where he and I would disagree, because I would say, well, the fundamentals would give me a heads up. And it might, because again, I'm not saying me versus him. I'm better and he is worse. No. Don't do any of that, okay? Don't read into anything. What I'm saying is where we would differ is I would try to use that information, the fundamentals and seasonality, for example. I would try to adjust faster than the technical strategy would adjust. And sometimes that would work for me. Sometimes it wouldn't work for me. Okay. And so I think the conversation with an institutional investor, if you were going to sit down and someone was going to invest, let's say $10 million with you, very often there's a due diligence team that consists of accountants and lawyers. Okay. Very often there's a board involved. And the conversation would never go well if they said, should we own gold in our portfolio based on macroeconomic conditions? And you're like, I don't do that. What? I don't do that. But if there's a moving average crossover, I'll take it. Well, you're not answering their basic concerns, right? So you would have to say, well, that's an issue of inflation. So our models point out base cases, right? So let's talk about the base case. And then let's talk about the variables that would impact this as a best case or worst case scenario if the base case is not the most accurate, right? Like whatever. And you'd break it down. Let's talk about gold, baby. Let's talk about you and me, right? Let's talk about all the inflation that may be. So you would have to break it down and say, well, why would you want to own gold in the portfolio? Let's talk about that. Okay, great. And then let's talk about current market conditions and basic projections from that. Okay, great. Let's talk about monetary policy. What do I expect? What's being priced in? Let's talk about that. And you break it all down. But the board doesn't want to hear about your 15-minute chart on gold or your hour or your 4-hour, right? So all I'm trying to say is I'd like you to be great at both. And if you can't answer the question, should you own gold in your portfolio? Then maybe you shouldn't be trading it. Okay? So that's my thought process, if not like philosophy, that I think you should know both. And so one of the things we've talked about all week since last week, so let me put this back in perspective. I'm a bull, and I've told you why, so I'm not going to tell you again. But on Friday, I was laughing at the bullish market because we thought that that's where profit taking was going to take place. And that we go now to, okay, it's going to drop like a ton of bricks. Great, fine. But because of our macroeconomic bias and outlook for the changing monetary policy in the United States, there's a plan B up, plan A up and a plan B up. Okay? So the down is predictable, but it's also because of your fundamentals, you are a buyer of the dip. So down, down, down for 2 or 3 days is fantastic because you're going to buy it. Okay? And then you would be able to have an intellectual conversation about why July 1st. Why would you lock in profit? Okay? And that's the edge I would try to get over, let's say, an edge, right? I'm not better, but an edge over a pure technical trend trader is that, okay, and there's no way I can get this onto a chart, so I'll just make a price action here, okay? So let's say it comes up, and then we're here in July 1st, and I think the probability of down and I don't know the degree of down either, but let's say I thought there was a high probability of down. Then in this zone here, around July 1st, let's say the peak is July 1st, I could move my stop and jam it, or I could just take profit, if that made sense, and regroup and let it fall. Where a trend trader wouldn't have any of that anticipation. What I'm saying is I would anticipate through fundamental analysis, things like seasonality. Oops. Let me draw that again. Okay, like that. A trend trader would wait for the daily rollover. So the thing is, if you waited for the daily rollover to get in, you're going to be slow getting in, but then you're going to be slow getting out, and you probably get knocked out here. And you might be in here. And so you're in it for a long time. You're very, very profitable for a long time. And then you give a significant amount back. That's the weakness of a turtle trader. And the similarity between what turtle traders did. Like turtle traders were trend traders. And so I believe trend traders have improved the rules of engagement. But nonetheless, if you're purely technical, you're going to be lagging. Especially if you intend to be in it as long as possible, your out is always going to be, let's say, somewhat inefficient. Right? I'm just saying. So because you're attempting to stay in for a very long time. And if I can use fundamental analysis to say, well, I expect it to roll over now because I've looked at things like seasonality, or I have projections on, inflation or earnings or something like that going into the third quarter. And that would change monetary policy. That would shift risk on to risk off. And you would see a change in money market positioning and all that. You're like, I anticipate these things through various forms of fundamental analysis. So if I see it starting to weaken here, I'll get out closer to the top. I'm not saying the top, but closer to the top than a pure trend trader that would wait for, let's say, a 2155 cross down on a daily. Do you understand that that takes almost a month? Where I'd like to be out maybe 3 weeks earlier if I anticipated the breakdown. And then observe the breakdown with just more sensitive technical indicators than like in my case, a 2155 cross on a daily, right? Even if it was a 2155 cross on a hourly instead of a daily, and you're like, well, then that's too sensitive. Not if you've already anticipated the cross, then it's a confirmation, right? So anyways, whatever. I think you get it. Just trying to let it run, but I gotta know when to get out. Okay? And in the same way as you got to know when to get out, you also need to know why you want to buy it. Okay? And so see that X? I drew that last week, I think it was, maybe on our Sunday meeting. And the reason for buying that is that's a buy zone. And you're like, well, how do you know that that's a buy zone? It went down Friday, Monday, Tuesday, and Wednesday. How would you know that that was a buy zone? And then I go out on a higher time frame and I'm like, oh, well, it's simple. So to be able to have that confidence, you have to say, well, do I actually want gold in my portfolio? Would I recommend this to a board of overseers that has money that needs to be protected? And you would have to have an inflation versus disinflation versus, like, I'm sure in that conversation, you would have to show, okay, the potential for the Fed pause. When is it going to be, if at all, and why do you think so? And what are the projected ramifications of a Fed pause? So if you said Fed pause at the June meeting, what would the likely outcome be? Like, what does it mean if the Fed paused in June? And you can say, well, that's all being priced in now. And as the money manager, as the hedge fund manager, not the portfolio manager, but you acting as a hedge fund manager and a macroeconomist macroeconomic strategist. You're wearing two hats. You break it down economically first. You think the Fed pause in June. And then as the manager of the fund, you're picking the strategies and you're like, we believe this Fed pause, leads to, higher than normal levels of inflation, because the Fed has capitulated. They can't raise interest rates any higher without causing more harm than good. So we're at a baseline level of inflation that's significantly higher than normal. And under those economic conditions, owning gold is a reasonable idea. Putting gold in your portfolio would be a reasonable, normal hedge against that inflation. And they're like, good, we want that in our portfolio. I can buy you gold. Now, you don't need to tell them you're going to wait for, my ribbon to roll over on a 1 hour chart, and then I'm going to buy a dip. Okay? Oh, you're going to do this? That's not what they're interested in. They don't want to hear that. So if that's all you got is you're waiting for these things, then you're going to be lagging. Like you wouldn't know this is going to happen. So now you're going to sell, and then you're going to sell, and now you're going to sell. But now this one you're up. And what happens is your first trade is a loser. Your second trade is a winner. Your third trade is a winner. Your fourth trade is a loser. And you've spent 6 hours today working, and you're break even. Right? Look, dude, I'm not laughing at you. I'm laughing at me, because those were we know how much truth could be in there, right? So the idea is figuring out which trades you don't want. And that could be wrapped around your framework for your portfolio construction. Okay? So you might want 5% of your portfolio in gold. I'm not saying that's the answer, but that's something you might construct in your portfolio. And why is that? Well, that might help you. You might say, due to what you think is persistent inflationary pressures, you want to have some of your portfolio essentially hedged against inflation. That you're going to focus primarily on real assets. Do you guys remember, 6 months ago, I talked about me personally in my retirement account, which is just part of Forex trading, by the way. I've explained that in the past, right? So now you got to manage your stock portfolio as well as your Forex portfolio, because instead of paying taxes, money goes into my retirement account, which is great. So now my Forex trading leads to stock trading, because I'm limited to those types of things. But looking at something like this, if you recall 6 months ago, I started buying miners, not necessarily gold miners, but those that dig things out of the ground. You guys remember? How many people here remember that conversation 6 months ago? We talked about it many times. I bought Rio Tinto, BHP Minerals were examples, right? Digging things out of the ground, sort of old world, dirty businesses, not dirty like bad or dirty like climate, but just they actually get their hands dirty. Okay? Digging stuff out of the ground that needs to be used. Now, I would love to invest into farming. I would love to invest into water. I would love to invest into energy. I'd love to invest into, and what I'm talking about here is things like, where does gold come from? Where does copper come from? Okay. Oh, Tesla's going to make 2 million cars next year. Where are they going to get the cobalt? Where are they going to get the lithium? Okay. Now imagine that was the conversation I had for your, like, let's say you're the chairperson of an investment committee overseeing an endowment. And you're like, Wayne, tell us about the future. And this was 6 months ago. And I'd say, well, okay, based on trends, you want to own things. You want to own 200-year-old companies that have mining concessions all around the world, digging out copper, lithium, gold, silver, platinum, palladium, because all these things are going to be used at the very least in the clean energy revolution. Every EV needs this stuff. So these are long-term macroeconomic plays that benefit humanity. And instead of picking, should you invest into Tesla, what we're saying is, let's dig the stuff out of the ground, because every car company in the world is going to need the same cobalt, the same lithium, the same gold, the same platinum. So why don't we invest into that which would support that energy? Also, if you want wind, if you want to invest into wind, for example, just picking on wind, I'm like, well, which company and which technology and where in the world? And you have to become a really big expert in all those things. But we can just invest into the copper. Where does the copper come from? Okay. And all of a sudden we'd look at that, and in 6 months, those investments are up 10%, but they also pay 10%. They pay 10% a year in dividends. Plus the stocks are up 10, 20%. Okay. So how do you make decisions like that? It's very similar to what I'm explaining here. You should know why you want to own gold, not just that the moving averages have crossed over, so that you know you can hold this to July. You see? I want you to think that way first and foremost, and then you come to your charts with clarity of intent. And you'll see your technical indicators much differently. Oh, no, I didn't buy the zero gravity chair, but what I showed at that time was the effect of purchasing power parity due to differentials in the foreign exchange pricing mechanisms. So I said, you can take two zero gravity, they're not even chairs, they're thrones, I think they call them. They're huge, right? An American chair made by Dell, I think it was. No, Acer. Acer makes one for $25,000. You can get one out of Germany, I think, for $10,000. But the one in Turkey was like $3,000. And they're all kind of, at least ballpark, same family. Now, the Turkish one isn't as good as the American one, but it's very much the same idea. And but the $3,000 gave way more value. Like it might have been 80% as good with 70% of the same quality. But, 80% 80% cheaper, kind of thing, right? So you got maybe a better value. So what you do is you use the Turkish one for 3 years, and when it stops working, you throw it in the garbage, and you buy another one. But that's your purchasing power of parity, comparing zero gravity thrones, right? Now, I don't know what you think when I say Turkish, but let me just say it's a Turkish company manufacturing this thing in Turkey. That's why it's so much cheaper. But it wasn't like garbage, trash kind of thing. The company makes a lot of gaming chairs, like literally the kind of like the chair I'm sitting on now, like those types of things where they make chairs. Like you would recognize the brand. Now I forget the name of the brand, but whatever. It's not like some weird brand making a junk piece of junk for No, like. It's reasonable. It's a reasonable comparison. So, the thing is, my wife would kill me if I bought a toy like that. Yeah, I don't know. I got into trouble many years ago. I bought a golf cart, and it was like a $20,000 golf cart. And anyways, a semi-truck shows up. A semi-truck. Huge vehicle. Massive. Shows up to our house. And she's like, "What did you buy?" I'm like, nothing major. It's good. It's for the family, right? And here's the funniest thing. So the back of the truck opens up, and do you think they roll out my golf cart? No. It was a covered vehicle, right? It's a covered car carrier. So it's covered. You can't see anything. So the thing backs up to the house, and they pull out a Ferrari. They back out a Ferrari. And she's like, "Oh, no, you didn't." I'm like, "I totally did. Look at it." I'm like, "Yeah, baby, yeah. I've always wanted one." Anyways. Yeah, so she almost killed me right then and there. And then, of course, then the driver goes back in and he pulls out the golf cart and backs that out. Yeah. Yeah. And then they put the Ferrari back in. Yeah. But I played along with it, though, huh? I'm like, "What do you think of the color? That's not just a regular red. That's a $20,000 upgrade." Yeah. Yeah. Anyways, it was a golf cart. It was a nice one, though. Yeah, $20,000 golf cart. Amazing. Not worth it, but interesting. It was made by General Motors. It's called a GEM. So we owned that for a while, but it just ate through the batteries like crazy. So anywho, I want you to think like a hedge fund manager, a portfolio manager. I want you to be able to sit down with a potential investor or investment committee. I want you to think that one day you could pitch a board of why they should let you manage their money. And knowing more than technical analysis is the only way that that's going to happen. So over the years that we work together, I want you to move from pure technician, which gives you the capability of trading, but then I want you to become more and more and more and more of an investor. And combine the two, because then one day you'll find that you'll spend 95% of the time thinking about why. You're not really thinking about today. You're thinking more about tomorrow. You're thinking about more about next week, more about next month. You're thinking more about the rest of the quarter. You're thinking about how all these things fit into the year and the monetary policy based on economics now and the changing economics to leading to a changing in the policy and where we are in the business cycle and all this stuff. 95% of the time you're worried about the position in the business cycle of where potential GDP is and where actual GDP is and the monetary policy to be employed and how that'll impact your foreign exchange market. And then you open up your chart for today and you're like, oh, I'll pass on that. Or you're like, oh, I can buy the dip. And it'll change the way you look at your charts. Instead of your charts telling you what to do, you're measuring whether this is a good opportunity for you to engage or to not be a market participant. Because you have a strategy. If you're going to build 5% position for gold, first of all, you've made the decision on why. But now you know about entry and risk management. Okay. You see? That's where that's my intention for you. And I hope you're okay with that. Okay? Like looking at this, one of the things we talked about yesterday in the day trading group, though, that if there's bullishness, it has to live there. If you're a bull, it has to live there, or you walk away. Why are you walking away? Why are you walking away? Right? No entry occurred. And why would you walk away? Because it's a long way to Tipperary. Yeah. So, yeah. Filling the gap. Well, that was actually, I threw that out there, but it was like 3 weeks ago, right, Maida? I threw that out there of one possible scenario. So I'm not going to claim being, oh, look at me, I'm right or something. But it was throwing out there as a potential scenario. I don't like that. I don't like it. But, I don't know. What can I say? But technically, if we're going to be technicians, and this is why I said, if it doesn't go up, then walk away, if you're a bull. Okay. If this range, I didn't say up, right? I just said, if you catch this, go for 100. Don't try to make 50 cents, right? Because it's such risk. Like, dude, you don't take a shot like that and pull 50 cents out of oil, right? Come on, bro. Come on, bro. Right? Because you're on a precipice, right? Like, right? Like, can you imagine being on the roof of a skyscraper and your friend says, I'll give you $5 if you can stand on the edge for 1 minute. You imagine you're on top of a 50-story skyscraper and your buddy says, I'll give you $5 if you can stand on the very edge for 1 minute. Hey, $5? It's not worth it. Right? So if you're going to take that risk standing on the edge, the precipice of a deep, dark pit, you got to get paid more than 50 cents. Come on, bruh. Right? Now, 50 cents on oil is $500, but still. So if you're going to buy it at 79, come on, get paid 10 grand, get paid 20 grand, right? Like, come on. Now, down. Okay. And are we waiting for a gap fill? Okay, you could, somewhere around 75 to 73. Yeah, maybe. Sure. Okay. Yeah. Could be a rabbit. Well, like when I said, because I remember it's right when I got back from Italy, right? And this had occurred. And I think we were up here when I got back. I said, well, this is the gap is created by the OPEC announcement to cut production. But I said, you have to ask yourself the rationale, the reasoning. I hope you guys remember this conversation. And I said, I think OPEC is cutting because they know the Russians have successfully found a way to get all their supply out of the country. And that everything Europe is doing to prevent that from happening is just failing. And that Russia's pumping out as much oil as they possibly can produce out of the ground. And then they're finding every rat hole to get that oil production out of the country and convert it into cash to finance their war. And so OPEC knows this and goes, oh God, oil's going to drop to like 0 or something, right? So anyway, the first move, this giant gap, is the world's like, oh my God, OPEC. And they don't ask why. Why would they do it? And now we're probably learning that, well, there's enough supply. Okay? Another way of interpreting this is that economic conditions, aka demand, is not as great as expected. Meaning we're just simply in a risk-off mode now. Okay? A third way of looking at it is this goes back to last Friday, in which we anticipated, I don't know if it's this particular market, but many markets were at profit-taking prices. And that was a time to get oot, as they say in Canada. And at some point, maybe there's a time to get back in. Cool. I can tell you that the 5-year average of inventories of oil look like this, and oil inventories in the United States look like this, then they look like this, and now they look like that. And we have about enough. And that, I believe, that this giant gap we had was truly overdone. And when we were down here, it was because we were up here. We had more than enough oil. the amount of oil the United States was producing was the highest ever. And now we're about average, right? If you had a median line, it would look like this, right? But it is falling. Okay, it is falling. And so this will probably stabilize somewhere. The EIA believes the average price will be 85. Oh. We also would assume that based on some seasonality that some demand might be built in. So if you do all of that and you've decided you want to add some WTI, you want to add some energy to your portfolio, you would look at all of this and you might conclude we got some seasonality for demand. We have some price adjustment based on overreaction to OPEC, and maybe some concern about demand destruction. So for you to take the risk, you want to look at owning the energy at a lower price. So we have this for, right, which kind of gives you the gap fill, right? It's old support plus it's your gap fill. So maybe around 75 to 73, you will look. You don't know. You're not going to just put a limit order there, but you're going to look to maybe to add some energy to your portfolio. So now you let it fall. And then you say, well, if it starts to do this, you will engage. Okay? Now, the interesting thing is you knew this yesterday in the day trading group, right? Because we talked about it here. And if there's no up, that's the next move. Oh, God. Okay? Oh, God. But that's the kind of level of detail that we go into. Do you know inventories? I think I closed the page. Right. I had too many windows open today, but I had it open yesterday. I think Jim gave me the link, right? And in the analysis, where's the short term? Oh, it was back there. Oh, can I go back? Oh, wait, I got to go to crude. Oh, it's not the right one, is it? It's not the right one. It's not the right one. No, that's not the right one. Anyways, you should be able to, if you're trading oil. See, it's the wrong one. Interesting. Anyways, if you are a trader of this asset class, and I ask you to, you should be able to. I should be able to ask you to draw the current level of WTI in storage. Is that it? Thank you. Oh, it's weekly, and I have short term. Yeah, thank you. I want to just find it before I click on the one you gave me. How come I'm so slow on finding it? Okay, what's new? What's new? Like, why isn't it under what's new, right? I guess I got to bring up what's new. monthly. No, within, no. See, like short term, but a shorter term. I want weekly, monthly. I get it by email. This is why I never find it, but I don't want to open my email. So where do I find weekly? Gee whiz. Short term? No. Markly. Anyways, so I'll pull up the one that Jim has just posted, and I'm sure I can find it quickly here. Yeah, see, you click on crude, and then you go down here, and this is what I just drew for you. Now, for you to draw this, you have to know the 5-year average of oil inventories in the United States, and you should know it by memory. Okay? So this tells me oil prices don't need to be high right now, but inventories are drawing down. Okay, look at this. Let's go all the way back to March. Okay, 478. Next week, 480. Next week, 481. They're going up, right? Inventories are going up. Prices should be going down. Now what? We go from 481 to 473 to 470 to 470 to 466. Inventories are falling. So, should you buy the dip? Well, you do you. Maida's like, not yet, Wayne, but you're on your way. You're on your way for sure, Maida. Okay. Okay. So this is what, if you remember, I said just 5 minutes ago, I said we're pretty close to the average. It seems about right, huh? Pretty close to the average. I said if there was an average, if you drew a line here, like what's the average? The blue line is what we have. Okay. So you could say we have enough oil, but the inventories are being drawn down, and it could lead to a shortage later this summer. Oh! You're thinking forward. So therefore, you might be a buyer of a dip. Oh! Okay. Which dip? Right. Maida says, yeah, my mentor. Well, the thing is, like, Maida, like, I always think of, like, pitching clients, right? There's always a client pitch. And I hate pitching in offices and boardrooms and stuff like that. So very often it's, you got a piece of paper, like even a napkin, right? I don't know that you're not at a place with a paper napkins, but anyways, you're in a nice restaurant and you're able to just like knock out in the middle of a discussion with a potential investor. You're having a nice dinner and everything's going great. They ask a question and you're just like, well, let's discuss that. And you just like, you pull out a piece of paper and you're like, well, here you go. Here's the seasonality and oil inventories. And, these are the 5-year averages, right? So you go this, and this is where we've been the last couple of years. And then we had this and we have this, and this is where we are now. And you just start drawing it. And you're like, look, I'll back this up later. Tomorrow I'll send you the chart from the EIA, the government website that tracks all this. I'll send that to you, but just bear with me. This is where we've been. This is where we are. This is where we should be. And therefore, here's what I think the near future is and how we should be positioned. And you're just doing this from memory. Dude, you're closing the deal right then and there. But when you're in the office, when you're in the boardroom and you're doing a PowerPoint and it's all been glossied and everyone's like, it's like too perfect, right? And they know you're just giving a pitch. You're just giving a pitch, and they sit there and they've seen pitches, right? You've seen this stuff before as a potential investor. Like when I was a VC, I'd look at 5 deals a day. Probably averaged 4, but I'd look at 5, often. Like, dude, you see a lot of stuff. You've seen all this before. You barely listen. You just, the presentation's glossy, but you're glossing over, right? You're like, oh, here's another guy. He says you can make 30% a year, but it's probably bullshit. And you're barely listening because you've heard all the nonsense before. It's just another presentation. But if you can do that sort of on the fly, on the cuff, map out, stuff like that, you stand out. Yeah. Is it necessary? Not to be a trader, but to be a portfolio, to be a hedge fund manager, probably is. Okay. And of course, if you can do it with charisma, like you see, like I get fired up, right? I get fired up. I love what we do. I love it. So I get fired up on this stuff too. And that usually seals the deal where you're like, okay, this jerk, here's what the investor's thinking. This jerk is tracking this data out of the government website, and he can pull it up by memory, and he is excited about this. All right, he might be a jerk, but that's the kind of jerk I want managing the money, or part of it. They're not going to give you all the money either, right? So anyway, so you're like, I'll give this guy a shot because, if this is what he gets fired up about, that's the jerk I want working for me, right? So anyways. So there's the S&P hung up on the central pivot, hung up on the 4-hour 55. Bitcoin is hanging in there, but not ready to breach. So it doesn't tell me. It doesn't tell me. If you were a bull on S&P 500, you'd probably be buying it right now. If you were a bull on Bitcoin, it's too late. So if you were a bear on Bitcoin, you might be selling. And so you better know which battles you want to get involved in. Selling the S&P 500 right this second sounds dumb to me, but you could buy it. You'd have to be a bull. You'd have to be risk on, so you'd probably be buying gold. Probably, it's when I look at Bitcoin on the 15, it's late. When I look at it on the daily, it's great. Late and great. So you either now buy the dip or you buy a higher low breakout, what we call a roll reversal. So you either buy this dip or you buy the next roll reversal. And you're going to be spending the day being patient and disciplined. But there's stuff out there for you. Okay? Oh, she says, we're 2% above the 5-year average for the week. Sweet. Not bad. Not bad for memory anyways. So, hey, man. I love what we do, and I love you doing this with me. So I hope you appreciate this community we have on YouTube. I hope you appreciate the live stream every day. But remember, it doesn't cost you money, but it does come with an obligation. Would you click the like button? Would you please leave a comment? Maybe document something, a key takeaway, document one bullet point for the day, that'd be great. If you're in FX Bootcamp, all the swing trading members and the day trading members are gathering at 4 p.m. to plan all next week. Typically, the meetings are 3 hours long. Like, it's not a joke. It's the real deal. So I'll see all those members at 4 p.m. It is Thursday, right? Wait, maybe it's not Thursday. It is Thursday. Good, I had to double check. So it is Thursday, so I'll see day traders and swing traders at 4 p.m. Yeah. So again, thank you for being on my team. You give me the strength to get out of bed and do what needs to get done. When I need to be patient and disciplined, I have to be patient and disciplined because you're watching. Yeah, that's good. So thank you for being a positive influence on me. Peace on earth. May the pips be with you. May your profits be above average. And I'll see you soon.